It's now 4 down days for the Dow and the S&P 500. Investors still not feeling encouraged to buy stocks even after positive comments today from one of the most influential members of the Federal Reserve. Bill Dudley, vice chairman of the Fed and president of the New York Federal Reserve Bank, said nothing has changed at the nation's central bank, that plans to taper back its bond buying stimulus measures this year are still on the table. Listen to the words of Bill Dudley when asked if the Fed could pull back on its asset purchases this year.
I certainly wouldn't want to rule it out, but it depends on the data. And the thing that we really want to emphasize is that it's driven by data, not by time. So when the chairman said later this year, that was conditioned on the economy behaving in a way in line with the Fed's forecast. So if the economy were behaving in a way aligned with the Fed's June forecast, then it's certainly likely that the Fed would begin to taper later this year. But whether that's going to happen or not remains uncertain.
Meanwhile, despite the markets in a sort of holding pattern right now, the Fed continues to buy $85 billion in bonds every month, just as it has for the past year.
Well, stocks extended their recent slide with no developments on the threat of a government shutdown in Washington and conflicting data about the U.S. economy. Home prices way up in July, but consumer confidence for this month declined. Stocks moved lower into the close, erasing earlier gains. In the end, the Dow fell 66 points. The S&P was down 4, but the tech-heavy Nasdaq was able to squeeze out a 3-point gain.
Our guest tonight has a theory on why stocks aren't rallying, even though the Fed is still stimulating the economy. Peter Boockvar believes the markets are beginning to disconnect from what the Fed says. He's chief market analyst at the Lindsey Group. Peter, so nice to have you here on the set with us.
It's great to be here. Thank you.
All right. Talk us through this disconnect between what the Fed says and how the markets react. After all, it's only been 4 days since that Fed decision.
Yes, but it's amazing in that 4 days. We had the massive rally last Wednesday and the euphoria of the Fed doing nothing. And in 3 days, we gave it back and then had the 4th day. People aren't used to this. Investors are not used to this. They're used to the Fed giving the market what they want, and then the market's responding with sharp rallies. The S&Ps are up about 20% this year, and I argue that a lot of that has to do with the Fed. Well, here the Fed was incremental in giving the markets what they wanted, and the markets aren't following through. It was 2008 was the last time that the Fed was easing, but the markets ignored it because obviously the system was on the verge of collapse. This time around, I'm wondering what's going on. There's something different here. The market's saying something.
So what is trumping the Fed in this case? Is it the concern over a government shutdown? Is it concern over the debt ceiling debate that we're going to face right after that? Is it concerns raised about terrorism in the wake of what went on in Kenya? What is it?
It could be those, but I'm wondering if maybe the stock market, again, which has used the excuse of QE this entire year to rationalize every single rally, that maybe we've stretched the rubber band so far between the spread of where stock prices are and where the underlying fundamentals say they should be. We've had low single-digit earnings growth this year. We've had 2% type GDP growth this year. That doesn't substantiate a 20% rally in the stock market. So we've had this expansion of the P multiple because of the Fed. Well, in the last 4 days, kind of squishy trading, it's telling me that maybe the Fed, which lost control of the bond market to some extent since May, is maybe losing its influence on the stock market now also.
All right, let's say you're right about all of this, and this is weighing on investors. What does this mean for the outlook for the markets? Are we in for a big market correction, maybe a bear market even?
Well, any tape watcher that's watched the action since Wednesday's big rally has to take a step back and say something's not right here. And if that is the case, we may be on the cusp of a correction. We haven't had a 10% correction in a few years. So there's an argument to be made that the best is in. If that the Fed can no longer generate higher stock prices, the fundamentals certainly are not. And maybe we need to start reacting on the downside.
So is the prudent thing to do to start taking some profits, take some money off the table, go to cash, and if so, what do you sell?
The problem with the market right now is almost every asset class is expensive. And that's the case with most sectors of the stock market.
Certainly that's what Buffett said last week. He was having a hard time finding bargains.
So raising cash in a variety of industries, I think, is the prudent thing to do. It's been a great year. But the market has acted differently, as we said, for the last 4 days. Raise some cash. It provides a buffer. It provides some dry powder. Don't be afraid to have cash, even though everyone says don't be in it. It's a place to be if the market's going to correct.
All right. Thank you so much, Peter. It's been great having you on the program.
Thanks a lot.
Good to see you, Peter.